Welcome back, everyone. Thank you for tuning in. Today, we're breaking down why the U.S. job market might not be as strong as it looks and what this means for the Federal Reserve, interest rates, and the broader economy. Let's start with the headline numbers. According to the latest job openings and labor turnover survey, job openings fell by 176,000 in July, bringing the total to 7.2 million. The job openings rate dropped to 4.3%, which matches its lowest point since mid-2020. That might not sound alarming on its own, but here's where things take a turn. For the first time in over 4 years, the number of unemployed Americans has surpassed the number of available jobs. And this is where it gets interesting. As of July, there were 7.3 million unemployed people, which is more than the number of open positions. And just a year ago, for comparison purposes, during that hiring boom, there were more than 2 job openings for every unemployed person. There is a big difference. Well, today that ratio has fallen below 1. That is a significant shift, and it tells us a lot about where the labor market is headed. This is yet another data point that underscores how this job market is frozen, and it's difficult for anyone to get a job right now. It's not just about numbers falling, it's about people staying effectively stuck. The hiring rate hasn't moved, the number of people quitting their jobs is quite flat, even layoffs appear relatively stable on the surface. But that's only if you look at the first estimates, revisions to previous months, and you know that we've had so many revisions to previous months, well, it keeps happening. Revisions to previous months, particularly June, show a much darker picture. The number of job openings for June was revised down by 80,000. More troubling, layoffs and discharges for that month were actually revised up by a staggering 192,000 jobs. This is not an isolated incident either. We're seeing a pattern. We're starting to see a very deliberate pattern here. Negative revisions to both job growth and layoff data have now shown up across multiple reports, including the main July jobs report, which revealed far fewer jobs added in May, June, and July than initially reported. Only 106,000 jobs were created over those 3 months, and that number is barely above the level needed just to offset normal attrition in the labor force. For context, economists estimate that the United States needs between 80,000 and 100,000 new jobs every single month just to keep pace with population growth. So what's really going on here? That is the big question. Economists believe these negative revisions suggest that businesses responding quickly to government surveys, the ones reflected in initial estimates, are generally in better shape. So they're doing well and they respond quickly. Meanwhile, the businesses that respond later, whose data shows up in revisions, are the ones struggling. So there is a big disconnect in that data, as you can see. And that is a worrying signal because it implies that trouble in the labor market may be more widespread than originally thought. One of the clearest signs of weakening demand for workers is coming from the healthcare sector, which has been one of the biggest engines of job growth in recent years in the United States. Job openings in healthcare and social assistance dropped by 181,000 jobs in July alone. The job openings rate in that sector is now at 5.1%, down from 6.3% just a year prior. Other sectors like arts and entertainment and even mining and logging also saw significant drops in job openings. At the same time, workers themselves are choosing to stay put. The quits rate, which is a measure of workers voluntarily leaving their jobs, often for better opportunities, held steady at just 2%. That is a strong indicator of uncertainty. People aren't confident that there is something better waiting for them out there, and so they're not leaving their jobs even if they want to. There are so many people like that. This all adds fuel to the argument that the labor market isn't just cooling, it is potentially slipping into something worse. And that brings us to the Federal Reserve. 2 weeks from now, the Fed is meeting to decide whether to cut interest rates. For months, they've been in a challenging position, as you know very well. I report on it quite frequently. They've been trying to fight inflation without tanking the job market. But now the question is shifting. The question now is the job market already weakening faster than they even expected? Fed Chair Jerome Powell recently called the slowdown in labor supply and demand, quote, curious. He said it was curious. And he also said that downside risks to employment are rising and could show up suddenly in the form of mass layoffs and a spike in unemployment. Those were Jerome Powell's words just 2 weeks ago. That's what makes the next few data releases so important. That is something to be aware of. On Friday this week, we will get the August jobs report. Then key inflation data follows early next week. If job growth stays weak and inflation keeps easing, the Fed could decide to cut interest rates at their upcoming meeting. If the data is worse than expected, which is quite likely, we could see more aggressive action. Following the release of disappointing job report, President Trump actually fired the Labor Department's chief statistician, claiming the numbers were rigged. He didn't provide any evidence for the claim, and economists across the political spectrum criticized the move as political interference, which of course it was. That kind of action injects even more uncertainty into an already delicate situation. Markets don't like uncertainty. We know that very well because it results in volatility, and neither do workers who are trying to figure out if now is the time to change jobs, to move, or just retrain. One last factor to watch here is immigration. Economists, even those at conservative institutions like the American Enterprise Institute, say that Trump's immigration policies are creating a drag on the labor market. With fewer people entering the country and more people leaving, net migration is expected to decline by over 200,000 in 2025. That means fewer workers available, but also fewer consumers to support the demand. In the long term, that could actually reduce overall U.S. economic output. Now, of course, there is a great argument to be made that we do need to secure our borders, and that is a valid argument. So I think there has to be a compromise in this particular situation. So what's the bottom line? Well, the labor market may still look solid on paper, but the cracks are becoming too big to ignore. Job openings are falling, layoffs are higher than we thought, revisions to earlier data show things have been weaker than we even realized, and for the first time in 4 years, there are more job seekers than job openings. The Fed is definitely watching, markets are watching, and if the data continues to disappoint, we could be entering a new phase of this economic cycle, one where interest rates fall, unemployment rises, and political pressure mounts. Let me know what you think about the labor market and what do you see in your area if you are located in the United States. I would love to hear from you in the comment section below. Thank you so much for watching. Thanks for joining me. Please support the channel, like, subscribe, and share. And also, I would love to see you on my other platforms on Substack and Patreon. Make sure that you follow me there as well for more content. Enjoy the rest of your day, and I will see you back here on my channel tomorrow. Take care.